Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Joining us today to make the case for building an allocation towards global small caps is the co-portfolio manager at the Royce Global Small Caps Premier Fund, Steven McBoyle. Great to see you here, Steven. It's a pleasure to have you.
Thank you for having me. I'm looking forward to this.
So Royce is seen as a pioneer in investing in global small caps. Could you walk us through a little bit about the group's story, your own background, and how you advocate for allocating to global small caps?
Certainly. So, though I've lived in the United States for most of my life, interestingly enough, I was born in New Zealand. I had lived in Australia during my youth, educated in the United States as well as Canada, began my career as a chartered accountant, and then ultimately became a CPA in the United States. Went on to earn my MBA at Columbia University before entering the world of money management, where I've been managing small and mid-cap assets in the U.S. as well as globally for now close to 30 years. As it relates to Royce Investment Partners, we are the small cap specialist in the United States, managing multiple investment strategies, different styles, again, across U.S., international, and global strategies. Really fun fact, our founder, Chuck Royce, began the firm in 1972. Interestingly enough, at that point in time in the U.S., there was not an index. The index, the benchmark, Russell 2000, was not actually formed until 1984 based upon 5 years of back testing. So unquestionably, as it relates to the definition of pioneer status, that is us. We, again, today, as distinguished and as differentiated as we were back then, today, we have first and foremost one of the more tenured investment professional resources of some 27 with tenure in excess of the underlying peer group. We have what I like to refer to as investor alignment. We eat our own cooking, which is to say, if you look at assets managed by portfolio managers, 85% owned by the portfolio manager themselves, more than $1 million. Employees, family, $100 million invested in Royce. Importantly, too, also as it relates to the specialist status and focus, if you were to look at all firms in the United States that manage over $5 billion in small cap assets, we are the only firm with 95% of our assets solely in small cap. So again, specialist status certainly applies to ourselves. So yes, indeed, we think we bring, again, there's not many managers that have been managing in small cap, let alone the 90s. But the 70s. So we think we bring unparalleled institutional knowledge to bear in what we think is a remarkable asset class, and we do so domestically, internationally, and globally.
So Steven, with bond yields below their historical average and with valuations looking pretty lofty in terms of equities, a lot of advisors, asset consultants, and fund selectors that are watching this, they have that dilemma about how to meet the needs of their clients, but also without taking on too much risk. What's the argument for having a global small cap allocation to help achieve that?
We like to think of this asset class, global small caps, as truly the Goldilocks asset class. Indeed, from an asset allocator's perspective, we think that there is not only performance related attributes, consistency in terms of performance, and again, risk arguments to be made. This is clearly an asset class that is large, inefficient, from an asset allocator perspective, one that we think unquestionably should be top contender. Happy to get into the reasons.
A lot of people are looking for that differentiation and that ability to have a global allocation that allows diversification. Many investors look beyond their core towards emerging markets. Could you capture why global small caps, to your mind, is for, the Goldilocks opportunity set?
Yeah, indeed. Let's get into this. So first, of course, from a global allocator's perspective, one has to, when looking at an asset class, so determine the asset class that they're going to replace, and clearly performance tends to be the threshold that one has to pass. And here, if you look at global small caps, the performance argument is extremely strong relative to large cap. So if you look at annualized returns on a 5-year rolling basis, global small caps have outperformed large cap. If you do so on a 10-year basis, one and the same. So you have the performance argument. global small caps relative to large cap. Secondarily, and we like to think of investing from a two-sided coin, performance and risk, consistency, importantly. So if you look at global small caps relative to large cap, consistently, global small caps have outperformed large cap on a very consistent, again, annualized rolling return basis, 5 and 3 year basis. Now, risk, importantly. First, volatility. If you look at global small caps, volatility is only, surprisingly, modestly higher on a 5-year, 3-year, again, annualized monthly rolling return basis relative to large cap. From an asset allocator's perspective, perhaps most importantly, you have to think about risk-adjusted returns. And so here, what you will find, again, using a classic Sharpe ratio, global small caps, arguably far better than global large caps. And as I like to say, perhaps one of the more important definitions of risk is permanent loss of capital. So as we know, lost dollars are harder to replace than gain dollars are to lose. And so importantly, it's notable that if you look at, again, we like to look at rolling return basis, annualized 5-year rolling monthly periods, you will find that global small caps have fewer no or negative return periods. If you look at the same definition over a 10-year period, you'll find that global small caps, again, have no negative return periods. Again, all these metrics, as I mentioned, are back to index inception. On that definition, global large cap does not pass. So interestingly enough, again, from a performance, consistency, risk perspective, you have global small caps, arguably, again, as I mentioned, a top contender for global asset allocators. Now, you mentioned emerging markets. Similarly, again, performance on the same sort of metrics are better than they are relative to emerging markets. And that may be very surprising to most of your audience that, again, global small caps outperformed emerging markets over, again, annualized returns, 5 and 10-year monthly rolling periods. Interestingly enough, again, back to the allocator's perspective, from a adjusted risk return basis, more attractive relative to emerging markets, and they do so with less volatility.
Now, Stephen, you've issued a great white paper which looks at a lot of this. The performance is there, but perhaps not all the allocator behaviors are mirroring it. You've referred to the global small caps market as an undiscovered country. Can you explain what you mean by this?
So as a not only an investor, but an individual that likes to travel, I absolutely love this analogy. And it's really quite stark, and it's as simple as this. If you look at global small caps, 1% of UCITS, and again, put this in perspective, this is a $10 trillion market. 1% of UCITS are in global small caps. So by definition, this is entirely undiscovered. And again, from an asset allocator's perspective, again, I can't help but make the point with the performance, consistency, and risk arguments. Again, this is the Goldilocks asset class, absolute relative performance advantage, better risk-adjusted returns, and more so on a consistency basis.
Now, Stephen, another statistic that might surprise people is the outperformance compared to large cap. Could you explain why you think, what are the key reasons for this, that global small caps actually has the better performance?
So this is, again, a function of being compensated for, again, underlying risk. We would refer to it as the small cap risk premium at work. 2, you have under-owned structure as it relates to small caps. And you do tend to have what we refer to as kind of the migration effect. As small caps migrate up into mid caps, that tends to add alpha as it relates to performance. And then again, as we all well know, within small caps, they do tend to be beholden more to the underlying economies that they serve, credit conditions. And here again, you would expect that the returns would be necessary to compensate for the underlying market concerns, as well as cost of capital considerations.
You referenced earlier how Royce Investment Partners have been in active pioneering this asset class before the index was devised. Could you talk to the role of active management in supporting the investor? This is a large and inefficient opportunity set. What role do you see active management playing?
Small caps, as I like to say, are the original alternative asset class. And within that definition, global small caps are truly the most misunderstood. And that's to say that this is a massive, inefficient market. And again, from an allocator's perspective, that obviously informs of opportunity. This is a $10 trillion market, 5,800 companies. Again, 4x combined underlying large cap and emerging markets. And so this is a highly inefficient market, which is to say, if you look at research coverage, global small caps, close to 20% from a research coverage perspective are only covered by one or no analysts. Using that same definition, large cap, 1%. So this is just a massive market, highly inefficient. And again, if you have the opportunity, as we do, to kind of bring institutional knowledge to bear, and we might argue, certainly in the U.S., that the informational advantage over time has lessened, but advantages still remain as it relates to pattern observation, time arbitrage. And so we have those opportunities to bring to bear, again, in this highly, highly attractive market.
I think you've built a really compelling case for adding global small caps to the portfolio. Thanks, Steven, so much for your insights.
No, I very much appreciate it. Thank you for having me.